Okay, hello and welcome to another video, and in this video what we're going to be looking at is the top 5 charts of the week. So this is actually a new format of the weekly brief or the weekly email that we do for those who have subscribed to the email list. And if you want to do that, then you just go to the website topdowncharts.com, and you'll see there in the down the sidebar it'll say subscribe, and you can do that. We'll put a link in on the information section of this video, but what I wanted to do as part of this new email series is to actually do a YouTube video every time, hopefully, ideally, do a YouTube video every time, and just take you through the charts and perhaps give you a little bit of context why I have chosen them and what's so great about them. So let's just start straight into it, I guess. So number one is inflation search trends. So let's explain this one first. So the blue line there is a composite of Google search trends. So this is from data from Google Trends, and that's basically giving you sort of indication of what kind of interest there is in various search terms. So if you think about this indicator, what it's looking at is, and I forget the full list, but it's things like higher inflation, why are prices so high, inflation protected funds, anything that I could find that, that had an association with inflation, and that wasn't showing, a structural trend. Like there's certain search terms that you can look at, and you'll look at the Google Trends result, and you won't be able to get any signal out of it. So what I've tried to do is basically find things that are consistent with the signal, and really focus on drawing out the signal rather than the noise. And what it seems to be is that there seems to have been a big surge in interest around inflation in February. And the past, when we've seen this before, so I guess the most notable periods were 2011 and 2008. These were when there was substantial run-up in inflation driven by commodities in both cases, basically. And I guess those two situations, it was sort of more reactive or coincident, even slightly lagging. You might wonder whether the current increase is perhaps predictive, maybe a sign of things to come. Also, in that respect, it's definitely something to keep an eye on, because, if we see a global generalized increase in inflation, then that's going to have pretty meaningful impact on the central banking outlook. Number two, and so these are all completely unrelated. There's probably going to be some relation between them, but they're just I've picked them from, by the way, all the various articles that were done. So, for example, this one comes from an article which I think is something about expecting higher volatility, and if you wanted to read more about that, you can click on the read more link. Anyway, this one is the rolling 12-month count of daily price changes exceeding 1 or plus or minus 1%, and you can see there, after hitting 50-year lows in January this year, it has decisively turned up. And I think if you think about how to interpret this, when you get a turning point in this indicator, sometimes it happens at the start of in the early stages of a new bear market, as it did in 2007, 2008. Or it can actually be, correlated, where you have a little bit of a more, I guess, erratic bull market, which was characterized there quite succinctly in the late 90s. Number three, this is a bit of a favorite of mine. It's called the State Street Investor Confidence Index, and that's one in the red there, and that is specifically, that's the one for Asia. And if you understand State Street's business model, basically it looks after money for large and investors as pension funds, fund managers. It's called a custodian, and basically it holds assets on behalf of particular funds or groups of individuals, etc. It's global custodian business is something like 15 trillion assets under administration. So when you have that kind of funds under your management or under your administration, then you know if you can track what some of the metadata there, that can produce some pretty interesting insights, and kind of meaningful in the sense that it's quantitative and reflects actual patterns of allocation, then and that this is what you get. So the 100 line there, so we're looking at the right hand axis for this indicator. The 100 line is a sort of a line of demarcation where readings below 100 imply that the large institutional investors are reducing allocations to risky assets, so increasing allocations to cash and bonds, whereas readings above 100 indicate greater allocations to equities and other growth risky assets. So you can see there, basically they're increasing exposure. They were buying in January as well, but now they've intensified their buying in February. And it's quite interesting because if you look back, when this indicator's kind of surged previously, seems to be that they are fairly good market timers in aggregate. Maybe they're a little bit early in, during the collapse of the Chinese stock market bubble, but they picked this last bull wave here pretty well, so it'll be interesting to see whether they can do it again. Number 4 was a shocker of a result for the official China PMI for February. I think that most of this is down to the timing of Chinese New Year. It was in the middle of February, and if you think about the Chinese New Year, what they do is they have a 1 week long national holiday. It's basically their version of our Christmas, and everyone travels home to have dumplings with their family and give gifts and all that sort of thing. So there is I guess because there's if you put on the traveling time as well, a lot of businesses will shut down not only during that week but before and after that week as well. So it causes quite a bit of disruption, and so I think that's probably the main driver behind that. But at the same time, a lot of the stimulus tailwinds are starting to fade, so it would not be out of place to see the China PMI rolling over, or at least slowing off, tapering off a little bit in the back of that. So is it in the right direction? Quite possibly, but it's probably a little bit too overstated. And the last one is global equity breadth. So for this, I'm looking across 70 countries, across the global equity universe, and basically testing or asking the question, how many of these countries are in a bear market, where the bear market definition is defined by a 20% fall or greater. And to sort of to make it easier to calculate, I've looked at a 52-week window. So basically, is the market down more than 20% off its 52-week high? And you can see there, interesting, when previous episodes or flare-ups in this indicator were. And at the moment, 0 out of 70 are in a bear market on this definition at the moment. And if you click on that, maybe I'll show you actually. So this will take you through to that article, which also had a few other breadth measures on there. So it also had 50-day moving average breadth and the def cross breadth. And since we're on the website here, if you want to subscribe to the mailing list, you can put your email in there and click subscribe. And administered now through MailChimp, so they're pretty good. They're pretty useful service that you can change your profile, unsubscribe or subscribe very easily. And that's about it. So yes, again, thanks for reading this email or watching this video. And that's it. Hope to see you on the mail list. I think that this is going to be a pretty cool feature to run, and I hope you think so too. And last of all, just be sure to subscribe to the YouTube channel so that you don't miss out any future updates.